So this is Senator Hertz, Chair of the Local Gov Subcommittee. We will start our meeting today here. We're going to dispense with roll. We'll just note that Senator McGilvery is not on yet, but he is working to get on. The other members of the committee are all in attendance. So everybody should have the agenda that was sent out. We're going to be discussing today. We're going to open up with tax increment financing, and then get some information on property tax growth on new property values, and look at some new tools that are coming about with that. And then follow up on a few other items from our last meeting, which had to do with non-levy revenue, and also CI 121, which was the more commonly known as the Prop 13 proposals that came out of California a few decades ago. So with that, I think we'll get going here on TIFs. And so what I want to focus today on tax increment financing is not so much about whether TIFs are beneficial or not beneficial. I think from my standpoint, I think most people will agree, yeah, tax increment financing districts have done a good job in promoting economic development in communities. What I would like to focus on is there an indirect cost to other taxpayers in increasing their property taxes who may live in a taxing jurisdiction that have a tax increment financing district within that jurisdiction? And that's something that is hard to measure. It's just difficult. As I've worked through this process and worked with Megan Moore on it, it's just hard to determine whether with the development inside the TIF, would it have happened without the TIF? Would some of it have happened? So it's hard to measure. So with that, we'll open up this, and Megan will start off with what she will present to us. So I'll turn it over to you, Megan. Thank you.
Thanks, Chair Hertz, and good morning, members of the subcommittee. My name is Megan Moore. I'm a research analyst with the Legislative Services Division. And can you see my screen?
Yes.
Okay. I'm going to talk about tax increment financing today. There's 4 different parts to the presentation, and I'll probably pause for questions. Also, feel free to interrupt me with questions if that's how you want to run it, Senator Hertz. I'm starting out here at a high level, and I structured this as kind of the 5 W's of tax increment financing. And in Montana, a city, a county, or a consolidated city-county government can create a district that uses tax increment financing. These districts are allowed to retain certain property tax revenue within the district to fund projects, and they exist initially for up to 15 years. However, they can go up to 30 or 40 years with bonds, and I'll discuss that in more detail. Currently, we have 20 cities with urban renewal districts and 7 counties that have targeted economic development districts within them. The reasons for which these districts may be created are to address blight or infrastructure deficiency. And the process by which a governing body uses tax increment financing is they have to make a finding related to the purpose of the district, create the district, and adopt a plan, and then notify the Department of Revenue. This slide covers the district creation details in more detail. We have urban renewal areas, which may be created by a city or a consolidated city-county. I'll just note for those out of state, we have 2 consolidated city counties in Montana. The purpose of these districts is to address blight through rehabilitation or redevelopment. And in order to create the district, they have to determine that there exists 1 or more blighted area with at least 3 factors of blight, and those factors are listed in our statute. And then the government adopts a resolution of necessity showing the blight finding, notifies property owners within the district, submits the urban renewal plan to the Planning Commission, and allows 60 days for receipt of recommendations. and then holds a hearing on the plan and finally adopts an urban renewal plan that includes the tax increment financing provision. For targeted economic development districts or TEDs, the process is pretty similar. However, these can be adopted by not only cities and consolidated city counties, but also by counties. And the purpose of these districts is to develop infrastructure. They must be a continuous area found to be deficient in infrastructure, and they must be able to host a diversified tenant base with multiple independent tenants, and they may not include an area that already uses tax increment financing. Similar to the urban renewal districts, they adopt a resolution of necessity finding infrastructure deficiency and adopt a comprehensive development plan in a public meeting that includes the tax increment financing provision. Now, before we dig into the actual mechanics, there's a few definitions that we need to all understand. The first one is very basic. It's the actual taxable value, which is just the taxable value of an area, the value of all the taxable property. The base taxable value is the actual taxable value of all the taxable property within the district before the effective date of the tax increment financing provision. So it's usually the base year would be 1 year before the district goes into effect. The incremental taxable value is then the amount by which the actual taxable value exceeds the base taxable value of all of the taxable property within the district. Then the tax increment is actually the dollars that are collected by applying the mill levies of all taxing bodies in which the district is located against that incremental taxable value. And then finally, I included taxing body here, and that's just to say that the taxing bodies include any district that any taxing body within which the district is located. So that usually includes a city, a county, the school district, as well as the state and special districts as well. So now, how does tax increment financing work? There's a graphic here for you. As you can see in the bottom left, that's the time at which the TIF provision is established. And in the bottom rectangle there is area A, and this is the base taxable value. So the revenue generated from the application of the mill levies to that base taxable value continues to flow to all taxing bodies as it did before adoption of the tax increment provision. Then area B is the incremental taxable value, which in theory is growing after adoption of the TIF provision. And when applying the mill rate to that incremental taxable value, again, we get the tax increment, and the revenue, that tax increment revenue is retained within the district to fund their projects. And then finally, area C is after the district expires, the incremental taxable value and base taxable value are no longer separated, and the entire taxable value is available for taxing bodies to collect revenue from. There are some levies that are excluded from the tax increment calculation, and these are based on various laws over the years, so there's kind of a tiered approach. For all districts, the 6 mil university levy is excluded from the tax increment calculation, as well as the 1.5 mil vocational technical levy, which is only levied in a few counties in Montana. Then for all districts that were created after April 6, 2017, any mill levy that's approved by voters after adoption of the TIF provision is excluded from the calculation of the tax increment. And then also for targeted economic development districts created after June 30th, 2022, the combined mill rate for those also excludes half of the state school equalization mills, as well as any portion of an existing levy designated as excluded by a local government. I'm going to walk you through an example here just to make it more concrete. This is the Polson Urban Renewal District. There's a map of it up on the right, and the purple area is the area of the Urban Renewal District. the red lines are the city boundaries, and not that important for this purpose, but the hatch lines are the tax exempt property within the district. So the total taxable value for the Polson Urban Renewal District in 2023 was $2.35 million. The base taxable value of when the district was adopted, which I believe was in the 90s, is $1.43 million. So that gives us an incremental taxable value of just under $1 million. And that's the amount that we apply the mill rates to determine the tax increment. So the combined mill rate here is just the mill levy divided by 1,000, and I'm showing you what mills are included for this district. So this is a district that existed before 2017. So the only excluded mill is the 6 mill university levy. And so these levies here are any levies that would be levied against the property in purple. So it includes the Lake County mills, the city of Polson mills, the school equalization mills, the local school mills, the county retirement and transportation mills, which are for school purposes, as well as special district mills, which I believe in Polson includes an aquatic center, a cemetery district, and a library district. So when you do that math, that leaves you with just over $500,000 for projects within the Polson Urban Renewal District. And Mr. Chair, I'm going to shift gears and talk about the TIF duration at this point. So if there are any questions about mechanics, now would be a good time for those.
Okay. I have a question and a comment, and Megan, you can verify this. So let's go back to the Polson's TIF. Polson recently passed I think it was a $40 million school bond levy. So I'm trying to figure out there would be a shift to taxpayers outside of that TIF district. So those taxpayers who are part of the increment, anything related to that bond is going to stay within the increment. But if I don't know what the dollar amount a year to make that bond payment was, but let's just say it was $3 million that they needed to pay the bonds off each year. So does that, since there's money that those individuals who are inside the TIF district increment, they're capturing some of that money that will be needed to pay the bonds. Does that mean that people outside the TIF increment, that the cost on their taxes may increase due to the fact that that bond needs the $3 million to cover their debt service?
Mr. Chair, so when the district is determining the mill levy, they would take the amount of their bond payments and calculate a mill levy that would be sufficient to pay the bond. And when they do that, they would have to take into account that the mill levy is included in the tax increment calculation. So that would be a part of their calculation for determining what mill levy is sufficient.
Okay, so indirectly, you could say that those people outside the TIF district are probably going to pay a little more taxes to cover those bond payments?
Mr. Chair, I think you can say yes, the mill levy necessary to pay for the bond would be higher.
Okay. Does anybody else have any questions on any of the things that we just went through? Ralph?
So is that, Megan, do you remember? I think I just looked up the statute. So when they calculate the mills they have to levy for the schools, they would, and fund that bond, they would actually take the tax incremental value out and calculate the money they need on the total taxable value minus the increment. I think that's the way the statute works. Is that your understanding as well?
Yeah, yes. Mr. Chair, Ralph, yes, that's the way they would do it. And that's the way any district does it, is they subtract out the incremental taxable value because they don't get to use that when they're calculating their levy.
Okay, thank you.
Any other questions? Seeing none, Megan, please proceed.
Okay, we're gonna talk about the duration of districts in Montana and the US next. In Montana, the districts terminate upon the latter of the 15th year after adoption of the TIF provision or upon the payment of bonds. And we have a statute that provides that bonds may not mature more than 25 years after their issue date, specifically tax increment bonds. That doesn't apply to all bonds. And so when you add those together, that's a max duration of 40 years. However, targeted economic development districts that were created after June 2022 are limited to 30 years. So they have to structure their bond issue so that the district is 30 years or less in duration. This is a chart showing the number of districts by expected termination in Montana. This is based on 2022 data from the Department of Revenue. And I will note that the way the department structures their data is they assume a 15-year termination until the district has bonded. And at that point, they would update the termination year of the district. So what this shows is that just under half the districts, 32 of 66, have extended their termination date beyond the 15 years with bonding. And among those that have bonded, 17 expect to terminate in the 31 to 40 year time frame and 13 in the 21 to 30 year time frame. All except 2 of the districts that will terminate more than 30 years after creation are urban renewal districts. However, part of the reason for that may be that TIFs were only authorized in state law beginning in 2013. So they haven't reached their first 15 years yet. And as of 2022, just one TIF has issued bonds. Most of the districts in that 21 to 30 year termination timeframe are actually industrial districts or technology districts. And these are districts that were the predecessors to TIFs. And the TIF laws kind of took those provisions and combined it into a new, more multi-purpose district. And new industrial districts and technology districts may not be created, but they still exist until they terminate. This is a map of tax increment financing term duration of districts throughout the country. You'll notice that tax increment financing is authorized in every state except Arizona. And in this map, the green states are states that have a TIF duration in their state law. The lighter colors is a lower number of years, and the darker color is a higher number of years. There are 26 states that limit the TIF duration in state law based on a number of years, and most of the highest number of states use a 30-year termination. That's in 11 states, and then 5 states use 25 years, and another 5 states use 20 years. For the orange states, they use something other than a period of time in state law, and that's what this slide is summarizing. There are 13 states in the District of Columbia that don't specify the duration in state law, and those are split into 2 categories. 6 states use the completion of projects as the termination date, and 7 states plus the District of Columbia have a termination specified in the district plan. There are then 7 states that allow the duration of a district to be extended. 4 of them can be extended by bonding. Montana is included in that list. And then 3 other states have some other way of extending the district. And then the last category is states that have a termination that varies by district type. There's 4 of those, and I included Montana in that list as well because of the different duration for the TIF, the newer TIFs. I'm going to switch gears now and talk about reporting unless there are any questions on the duration.
Does anybody have any questions about duration? I don't see any, Megan, so you can move forward.
Okay, this slide is a summary of TIF reporting in Montana. The first two lines are statutorily required reporting, and the last is some reporting by the Department of Revenue. So all districts in Montana are required to include in their annual financial report information about the financial activities related to the tax increment financing provision. And that those annual financial reports are filed with the Department of Administration, and they're available on the DOA website, which is linked in the receiving entity column of the presentation. In reviewing those reports, the information that was included for most local governments was very similar. It includes financial statements for accounts that hold tax increment, as well as information about bonds if the district has bonded. That would include things like the termination date or the maturity date of the bonds, the payments of the bonds, and the purposes for which they bonded. I then have a column on the right here that I called the usefulness of the information. So the advantages of these annual financial reports are that they're required for all districts, and they include basic information about the district. There are some shortcomings with this data. It's in very lengthy reports that may not be widely known that they exist. While they are available on a public website, I'm not sure how many people know they're available. Also, they're filed in PDF format, and some of them are not searchable, either because of how they were uploaded or how they were provided to the Department of Administration. Also, there's a lack of specificity in the law about what information is required to be reported, though it does seem that most local governments are reporting the same type of information. The next line is about urban renewal agencies, and I need to provide a little context here. In state law, for the urban renewal districts, a local government, a city or a consolidated city county may choose to assign their urban renewal powers to an agency within the city government. And if they do that, they are then required to file an annual report with the local governing body that created the agency. In Montana, I know that Missoula has their urban renewal statute structured that way, as does Butte Silverbow, and there may be others. And so those entities, the reporting of those entities must include complete financial statements, the amount of tax increment, and how the expenditures comply with the urban renewal plan. In reviewing the reports, I found that they include financial statements that are the same as the annual financial report, as well as detailed bond information, the amount of tax increment, and the detailed expenditure and project information. I'll also note that the report, while it's only required to be provided to the local government, it also is filed with the Department of Administration and is available on their website. And then also for example, the city of Missoula would also include, they're also subject to the reporting requirement on the previous line, so they're also including that information in their annual financial report. The advantages of this information is that it's a little more detailed about the projects. However, it's only required for urban renewal agencies, so there's not that many entities filing these reports. Finally is the Department of Revenue reporting. There is a statute that requires the Department of Revenue to report biennially to the governor. We call this the biennial report, and it's linked under governor there. And there is a statutory requirement about what is included in that report. However, it does not specifically require TIF information. But DOR does include that information, and the information included is the district name and county, the year created and year of expected termination, the taxable values, including the current year, the base value and incremental value, and then the estimated revenue collected for each district by levy type. The advantage here is that this is detailed property tax information. There is a bit of a shortcoming in that it's not statutorily required, so the department could stop doing it, I suppose. Also, the information does not account for law changes for new districts that are required to remove some levies for the increment calculation. And I'll let DOR talk in more detail about that, but As I understand it, they are relying on reporting from the local governments on the combined mill rates. And which is for a separate purpose, and they don't have good data on voted levies that might be excluded, or in the case of TEDs, whether there are other levies excluded at the discretion of the local government. This next slide talks about a nationwide lack of TIF transparency is found in a report by the Lincoln Institute of Land Policy called Improving Tax Increment Financing for Economic Development. And the quote that I have here is, in the most transparent cases, TIF authorities make publicly available the TIF plan and a record of annual TIF district receipts and expenditures, sometimes with a great deal of detail, perhaps even including account balances and fund transfers. So the report found that there is a lack of transparency and did make recommendations about increasing transparency, but I want to kind of analyze Montana based on that quote. So urban renewal districts and targeted economic development district plans are approved in public meetings, and these are generally available on local government websites. However, it may require knowing when the topic was considered, so you might need to know the dates in order to find those reports. Some localities do include the plans on local government websites in a more accessible way. And Senator McGilvray has a question. I can finish this slide or stop here, whichever you prefer.
Why don't you finish up this slide and then we'll go to the senator.
Okay. The annual financial reports do include the district receipts, expenditures, account balances, and fund transfers. Again, whether people know that information is out there is questionable. And then finally, the DOR biennial report does bring together the taxable values and estimated revenue for all the districts.
Okay. Go ahead, Senator McGilvray.
I was just wondering, Megan, are all these TIFs, TEDs, are they all required to have their finances audited?
Mr. Chair, Senator McGilvray, I think the answer to that is yes, because they are accounts of local governments. And so the local governments have, well, I guess that's a qualified yes. I'm not an expert on local government auditing, but I can get you this information. There are requirements related to the frequency of audits based on the size of the local government, I believe. And because these are financial accounts held by the local governments, I believe they would be included within the audit. And there may be someone in the meeting that is more expert on that than me. So I think it's a qualified yes.
Any
I
other?
agree with Mr. Chairman. I agree with Megan, and I can walk over and talk to we have an auditor in our office, so I can double check that if you'd like.
Thank you. I just think I would just like to know the firm that they are audited and just the general process. I don't need a lot of detail, just the general idea.
Yeah, I think one of the bigger issues, I've looked at a few of these, the TIF reports in Montana, and it's interesting. But I think, as was pointed out, more detailed receipts and expenditures might be a little more transparent on those type of issues, might be helpful to the public. I believe that information's there, but it's a little bit more digging for someone if they really want to dig into the exact details of what's going on in some of those TIF districts. So, is there any other comments or questions? Justin, you got your hand up? Go ahead. You have to unmute yourself.
Apologies. Are all TIFs to support bonds? Are there any like fund-based ones, or is there always a bond as a part of the TIF process here?
There's not required to be bonding. There are districts that do just exist within that 15-year period and terminate. They just collect the increment and do some probably smaller scale projects and then terminate. I think many of them do bond, and I think that's probably data we could collect through DOR. You know, you just anything that existed over 15 years would have bonded, so it would be pretty easy to tell how often they're bonding.
I guess related to that is who the bonds are acquired or delivered to? Are they, or who is providing the bonds? Are they known as a part of the transparency? Like, who is the local government selling the bonds to? Is that part of the known things in these meetings?
I don't know for certain on that. My guess is it would come up in the public meeting as far as whether it's included in the annual financial reports. I did not look at that specifically. I don't recall necessarily that information was there, but I also wasn't really looking for it.
Sure. All right, thank you.
Any other questions before we move along? Okay. So Megan, do you still have some slides to go through?
Yes, I have one more slide on the reporting, and then I have the your information request.
Okay. Go ahead.
So this slide is on TIF reporting in neighboring states. It was just kind of a way to look at what some of our neighbors are doing. And the takeaway to me is that Montana and South Dakota are kind of similar, and the other states are less similar. Wyoming doesn't have any state reporting. Idaho does require some filing of annual filing annually their current plans, including amendments or modifications. However, that does not seem to include current financial information. North Dakota does require an annual report to the Department of Commerce with total outstanding indebtedness, the balance of funds, and the name of the district. I couldn't find that these were publicly available online, however. And then South Dakota is interesting. Their Department of Revenue puts together an annual report on each TIF district in the state. And the report is not required statutorily. However, once the Department of Revenue decides to create a report, then the local governments are required to submit any information requested. So there is a statutory component that allows DOR to get that information. And what they're reporting is the aggregate information on the number and type of districts and their aggregate value, the creation and termination years, the location of the districts and the type, the taxable values, the general project description and cost, and then the estimated jobs created. And while I think when you look at the Montana information, you might have to look at multiple sources. That I think the Montana information is more detailed, but the South Dakota information is all included in one place. And in Montana, you would have to look at least 2 or 3 sources to get all that information. Then these last few slides are on an information request from Senator Hertz. And this is what he was referring to at the beginning. It's an attempt to look at the impact of districts on property taxes. And there's a number of caveats related to this that I'll have to go through here. So I just want to start with the theory of tax increment financing, which is that TIF creates investment and increases the property value within the district that would not otherwise occur. And because of that, the TIF impact on property taxes is neutral in the short term, because the taxes on the base continue to be collected by the overlapping taxing jurisdictions, while the taxes on the increment would not have been realized without the district. So there's no loss of revenue to those jurisdictions. I'll add here, there's a lot of scholarship on this, and I am definitely not an expert on that. You know, some find that TIF does create new economic activity. Some are neutral, some are negative, and I'm not going to cover any of that. What this analysis does is just creates an alternative scenario, that is that if some of the investment would have happened in the district without the use of TIF, allowing revenue from the increment to be retained within the district may increase mills or lower tax collections for overlapping taxing jurisdictions. So we made two assumptions and looked at two different scenarios. Scenario one is that the taxable value of the district is unchanged without the use of the tax increment financing. And the second scenario is that the taxable value is reduced by half of the total incremental value. I'll talk briefly about the methodology that I used here. So this was a little bit limited. If you remember the list of all the mills in the Polson district, I wasn't able to do the analysis for all of those. So what I focused on is the non-voted city and county levies. And I recalculated those using the determination of tax revenue and mill levy limitations worksheet. I think all of you will remember that city and county taxes are limited in Montana, and there's a way they have to be calculated using inflation and accounting for newly taxable property. So I basically just adjusted those worksheets by the taxable value scenarios and determined the mill levy that would have raised the same amount of revenue. Then I did a similar thing for the non-basic amount for school equity levies for the elementary and high school. And the reason that it's only the non-base levies is because if you use the base levies, you need to run that through the school funding formula and it will have broader implications. And we weren't prepared to do that for this analysis. So it's the non-base levies that excludes the county retirement and the county transportation, but it does include debt service. And for those, I just determined how much revenue those levies raised, and then removed the taxable value under the two scenarios, and then recalculated what the levy would have been without the districts or with the reduction based on the incremental value. A few limitations here, I already mentioned a few of them. Voted levies aren't included because we have poor data on them. It also doesn't include special improvement district levies, and the reason for that is because the way they overlap with the TIF districts is complicated and the boundaries don't always line up. School-based levies, I already talked about why they're excluded, and also the 95 mills are excluded as well. And then one other caveat I have here is that newly taxable overstates the impact here for cities and counties. And I'll just flesh that out a little bit. If you think about a jurisdiction that's growing, that the taxable value is increasing, which is what you expect to happen with the tax increment financing, is it's creating new growth and new value. In Montana, that newly taxable property in its first year is not considered when calculating the mill levy. So that allows the districts to have, the cities and counties to have some extra growth aside from their newly taxable property. But in this analysis, we know that the taxable value would include some newly taxable property, and there wasn't a way to figure out when to exclude it. So basically just know that it could be overstated because of that newly taxable property. So this analysis looks at 3 counties, Fergus, Lake, and Missoula, that Senator Hertz requested, and I'll just walk you through how it's structured. You have Lewistown, which is the large city in Fergus County, and then Fergus County Mills, and then also the Lewistown Elementary District and the Fergus County High School District in the columns. The top third shows you current law. It shows you the total taxable value for each of those taxing jurisdictions, as well as the total incremental value of the TIFs within those districts, and then the mill levy for each district. Then the fourth row there calculates the taxes per $1,000 of residential value using the mill levy. Then in the middle is scenario 1. That's without the district, the taxable value would be the same. Then it recalculates all the levies, estimates the taxes per $100,000 of residential value, and then shows the difference. And then the difference is summed in the far right column for the city, county, and the school districts. Then the same analysis is done for scenario 2. That scenario, I'll remind you, is that without the district, the taxable value would have been reduced by half of the incremental value. So as you can see, scenario 1 would have the biggest projected difference compared with current law, and scenario 2 is about halfway between, is about half of that. So I did the same thing for Lake County, and then the same thing for Missoula County. The only thing I'll note on the Missoula County one is, oh, I guess I will say, so Fergus County has Fergus County has one urban renewal district in Lewistown and one targeted economic development district in Lewistown. Polson has one urban renewal district in Polson. Missoula has 6 urban renewal districts in the city of Missoula and 4 targeted economic development districts in the county. So when you look at the total incremental value of TIFs for the Missoula districts, you'll notice that the value is different in the city, in the county, and in the elementary districts, and that's because of the complication of how the districts overlap with the taxing jurisdiction boundaries. And that's all I have, Mr. Chair. I'm
Okay.
happy to take questions.
Sure. So thanks, Megan. Yeah, this is very difficult to project or to calculate exactly what the impacts might have on other taxpayers. I really appreciate Megan working through this, but you can see the complexities of overlapping districts. Lewistown and Polson, a little bit easier because of one district and not so many other moving parts. But I think, as you can see, that there definitely is an impact, but nobody actually, how much is it? It's very hard to predict, because how much of the TIF would have, the new incremental growth would have happened without the TIF is unknown. And so, but I think there's some impact there, but it's just hard to quantify. So does anybody have any questions for Megan? There, I see Ralph's got his hand up there.
Mr. Chairman, I'll wait for people to ask questions to Megan. Danielle Vincent from the Local Government Center,
Okay.
Local Government Services Division is here she can answer the audit question.
Okay. Does anybody have any other comments, questions for Megan on anything we just went through? All right, Danielle, you're up.
Good morning, everybody. My name is Danielle, and I'm with the Department of Administration. I overheard the question from Senator McGilvery regarding the audits, asking the question about audits and how often entities are audited. So I just thought I'd pop in really quick and give you a little bit of information on that. So local government entities are audited per statute when their revenue levels exceed the threshold that's established by the Office of Management and Budget, and that currently is $750,000. So we look at their annual financial reports that are sent in to us, and we look at all of the information, including the TIF information. And if those revenue levels have exceeded the threshold, then we flag them for required audit, and we send them a notification letting them know that they need to have an audit. If the entity has an audit, and if they have TIF financing or TIF information, there is the requirements for how that is audited is included in what's called our compliance supplement. And it's the compliance supplement for counties, specifically is where I have the first reference. And our compliance supplement is posted on our website under the audit and reporting section. And I'm happy to throw the links into the chat for our website and for the compliance supplement and for the reports section, where you can find all of the annual financial reports, just so that you all have it as well and can familiarize yourself with it. But just wanted to quickly pop in and let you know that information.
Thank you. Yeah, it'd be helpful if you could maybe throw up those links.
Sure.
Could you, I would assume maybe the audit of a TIF probably depends on materiality, like any other audit is being happening. So the auditors may not drill down into a specific TIF due to just the dollar amounts that might be there or may not.
Right. Yeah. So there are specific things they have to look for, but you're right. Materiality always comes into play when it pertains to audit procedures.
Thank you. Does anybody else have any questions at all on the presentation here before we move into the Department of Revenue? Senator McGilvery.
Yeah, I just want to go back to Megan's last slide on the impact of a TIF on a typical home. I just want to make sure I understand it. And I just, yeah, if you could throw that back up. So in that scenario one, what you're suggesting is that in Missoula, the TIF would have about a $20 impact per year on a homeowner's property taxes. Am I understanding that right?
Sorry, let me get that back up there. I was trying to unmute. Okay, so Senator McGilvray, the $20 would be for the city of Missoula levy. If you wanted kind of the full picture for a taxpayer that resided in the city of Missoula, you would want to look at the far right, that $54, because they're also paying Missoula County and Missoula School District taxes. And
Okay.
so that would be $54 per $100,000 of residential value. If the person lived in Missoula County, then you would subtract out the Missoula City impact. But I just summed it all the way across for ease.
Okay, so thanks. So what I'm seeing here then, just to summarize, so it's $54 per $100,000 of home valuation. That's what the TIF would be costing for a taxpayer in the city of Missoula, it's in the county, et cetera.
Yes, Senator McGilvray, under the scenario that the taxable value would be the same without the district.
Okay, thank you.
So that's the question there is, how much of that incremental increase in taxable value, how much of that would have grown without the TIF? And I think it's honest to say that some of it probably wouldn't have grown without the TIF, but how much would is the question. Any other?
Yeah, is the
Go ahead.
base adjusted for inflation over time, or is it literally frozen at the time of TIF origination?
Mr. Chair, Mr. Ross, the base remains the same throughout the life of the district. There is a provision in law that I'd have to look at more closely, but if there's some kind of natural disaster or some reason to lower the base, there is a provision for doing that, but otherwise it remains the same.
All right. So I guess then it would be correct to say that the inflation gets fed into the increment rather than the base. And so that even if in theory it is perfectly neutral because of inflation, the real dollars is adjusted out of the other units because it gets attributed to the increment. That seems correct?
Yeah, I'd say appreciation in value. So yeah, if you would call that inflation, yeah.
Sure. Thank you.
Senator McGilvert, you have
Yeah,
another?
I just have one more question. So it was a few slides back, but you talked about Montana being one of only 4 states that can extend the duration of the district through bonding. And I just want to make sure I understand that correctly also. Yeah, this slide. So my understanding is what I'm seeing here is that Montana is only one of 4 states that through bonding can extend the duration of the district. So in reality, the district can be extended in perpetuity.
Mr. Chairman, Senator McGilvray, we still have the hard limit of 40 years. It
Okay.
cannot be extended in perpetuity. So it's our original TIF district is 15 years, and then many districts can extend to 40 years with bonds, except for TEDs created after June 2022, and they can only exist for 30 years.
Okay, thanks for the clarification.
All right, so I don't see anything else. We're gonna move on to the Department of Revenue. Dylan Cole's gonna provide some information that's available in the biannual report about TIF districts.
Yeah, thanks, Chair Hertz. This is Dylan Cole from Department of Revenue, Tax Policy and Research. I got a super short slideshow for you guys, just talking about what information the Department of Revenue has. And Megan kind of alluded to this in her slide about the reporting that the Department of Revenue does on TIFs. So what we have is the base and the incremental taxable values of the TIF, and we have the mills by the taxing unit. So that's what allows us to make statements like Megan was doing about how much dollars are diverted into the TIF from the city versus the county versus the schools. We also have the creation date of the TIF, and then we do know whether a TIF has bonded and the duration of that bond, which gives us an expected termination date. And like Megan was saying, if there's no bonding, that expected termination date is 15 years from the creation. If there is a bond, it's when the bond is expected to be paid off. What we don't have are debt amounts. So I know, for example, Senator Hertz last session was working with some groups that were trying to make limits on. I think a lot of times when you try to make legislation that restricts the ability of increment, TIFs say that, well, we already have these, we've already issued bonds on an expectation of increment. So if you try to retroactively change that, that's a problematic. The Department of Revenue doesn't have the information on these debt amounts. Like Megan was saying, it's discoverable, but it's not easily discoverable. And the information that we're providing is not mandated by law. So we're doing the best with what we have without spending a bunch of time combing the various annual financial reports of TIFs. And then the other shortcoming in this data that we have is that we can't tell which mills are voted. And that's important for districts created after 2017, because at that time, the legislature came in and said, if voters are passing a new mill, it shouldn't be subject to the increment because, because I guess there's a perception that voters weren't informed about what that increment is doing to the mill that's being voted on. So this is a clip of our table that's out of the biennial report. This is in the property tax section. It's at the very end of the section. And I just took a small section of the report because there's one for each TIF. And so it says the county the TIF is located in the district name, when it was created, and when it's expected to expire. And then you can see the total taxable value, the value of the base, and then the value of the increment. And then we've broken it down into the major taxing entities that are levying taxes in that area. Everyone in the TIF is paying, or everyone in the state is paying state taxes and county taxes, and countywide and local schools. If you are residing in a city or a town, then you're also paying those city or town taxes. And then miscellaneous is most oftentimes fire districts, sometimes cemetery districts, just smaller taxing authorities than a city. And then when you sum up all those different categories, you get the total revenue that the district is receiving in increment. And then this is out of our tax expenditure section. So this is the summary of all the TIFs going back to 2009. Again, the same information. This time we've cut out the base and the total taxable value, but it's got the increment and then the revenue that the increment is raising across the state from all the different taxing entities. And that's in the tax expenditure section of the biennial report. And Mr. Chair, that's really all I've prepared. So happy to take questions if people have them.
Sure, that would be good. And then Dylan, maybe in the chat or someone can provide it to us later, is the link to the biennial report so you can go in and look. The first slide that Dylan showed was primarily TEDs, which don't generate as much increment as a TIF does. But if you go to the biennial reports, you can see, and I believe like the city of Missoula is generating about $14 million a year that's going into their TIF increment. Bozeman and Billings are around 8 million. Great Falls is about $4 million. So you can get some pretty significant size increments in the larger cities and those who have multiple TIF in urban renewal districts. So does anybody have any questions or comments for the department? All right, so
Senator Hertz,
Senator McGilman.
I do have a unrelated question, but since Dylan is on the line, I'll ask it to him.
Yep.
Can you get me the information about how the department determines the valuation of homes? What's the procedure process formula that they go through to determine for taxation purposes?
You talk about determining the assessed value of a home?
Yeah, correct.
Sure. So there's 3 general approaches to valuation.
Is there, excuse me, is there just like a written document that tells how that's done, or is it?
There is Senator McGilvery, there is a written document that I can link you. It's pretty lengthy, but I'm happy to link that. I mean,
That'd be great. You give me just an overview now and then link to the document. That would be appreciated.
Sure. I mean, if we're just talking about residential values, it's almost always similar sales. So the department collects sales. So let's say, for example, the tax year 2025 reappraisal is coming up. The department is collecting sales from January 1, 2022 to January 1, 2024, and building models that try to predict what the value of similar homes would be to those that have the same characteristics of those sales. And that's used to form regression models that simulate the value of certain characteristics of the home. So what's the value of a bedroom? What's the value of a bathroom? What's the square footage value? All those characteristics are fed into models, and then that tries to predict the value on January 1, 2024. That's the quick summary.
All right. I'll look forward to reading the entire report.
Sure.
Any other questions related to TIFs? All right, so we're going to go into some public comment, and I would ask that the public try to focus your comment on the impacts to taxpayers within a city that may have a TIF or a TED in it. I don't want to get into the debate here as to are TIFs urban renewal districts good or not. So the attendees, I guess you can just raise, someone who wants to comment can raise their hand. So I currently don't see any raised hands up right now. So all right, well, I'll probably circle back since I don't see anybody right now. I might circle back to that. So without any public comment, we need to move on and discuss. So what's the next step for the committee in regards to TIFs? Does anybody have any thoughts? I have a few, but I'll throw it out there to others to see if there's something they want to dig into a little bit more, focus on something when it comes to the TIFs. Justin? Unmute yourself, please.
A problem, it seems like Montana is on the much more transparent side of TIFs than most other states. A problem that has come up in other states has been TIF districts being used in such a way that they are actually designed to work like tax abatements. Which is why I was asking that question earlier about is there information on who actually holds the bonds, for example? So if it's arranged in such a way that like they TIF a single parcel and then the bondholder is the owner of the parcel, that they're just the repayments are being made to them. And then this is acting like a tax abatement rather than a TIF. And it's The reason for doing it that way is that usually tax abatements are much more limited in terms of the duration than TIFs are. So, you know, sounds like it's less likely to be a problem in Montana, but might be worth, you know, doing something to look out for such cases if it's undesirable that such things are done. Seems like they're much more common when they're not bond-backed TIFs as well. So if it's just another thing that occurs to me is that how the actual increment is generated in practice would be a useful thing to try and dig into. So like if they need a bond payment in order to be made, if the TIF is repaying a bond, is the increment simply just defined to just be enough to cover the bond payment? Right. So that's a fairly common thing. So like if the base is frozen, but they need X million dollars, is the increment adjusted enough to make sure that X million dollars is approved? If that's the case, then the increment will be probably overstated, and the concern about whether or not this is negatively affecting other districts would be overstated as well, right? If on the other, if it's not, if it's the case that, and it sounds like it is, because it sounds like the base is just frozen permanently, then that would be, you know, and that is the actual practice, to just make the increment certain enough to cover the payment, then that would diminish at least some of that concern.
Yeah. So Megan, correct me if I'm wrong, but the increment is what it is. And it doesn't go up and down based on how much more they might need for bond payment. So that, you know, the local government has to be cognitive of what that increment is. There has been some discussions. That might be something too that we could look at is when a TIF gets close to issuing bonds, should then we maybe reduce the increment and just keep it there so it can cover the bond debt, and then the rest can go back into the tax base. So that might be something. I don't. Did I state that correctly, Megan?
I think so. The increment is a number determined by a pretty straightforward formula. I mean, you have the incremental taxable value, and because we have state level reappraisal, the Department of Revenue is the one determining the taxable value, so the local government can't be gaming anything in that regard. And then the increment is just the combined mill rate multiplied by the incremental taxable value. So you know, there's the levies that are excluded, the voted levies, but there's not a lot of control by the local government about what levies would be included or excluded. Only the very limited TEDs where they can exclude some levies, the ones that were created after 2022.
Yeah, I think there are some examples, Justin, you brought up about the bonds. I know of a few examples in Montana where the bonds benefited a particular entity, and that entity bought the bonds. And I think in this case, it was banks. So, I mean, banks are constantly investing in revenue bonds, tax-free bonds, and those came up and they purchased them. So, but kind of unique. I mean, obviously some of the bonding benefited a particular bank, and then they turned around and bought the bonds. So, but it's all pretty much, I think, most of the time those bonds are out there, you know, the public can bid on them. I believe the bond council usually goes out and provides those out to various individuals who might be interested in those. Any other comments on TIFs where we might want to pursue here? So I'll throw out there some thoughts, and mostly it's coming from previous legislative sessions. I think what we've looked at in the past is the definition of blight. Maybe, you know, shoring that up a little bit. What is truly the definition of blight? Because it's pretty broad right now. And if you look at some areas, there obviously some people said, well, that's not really blighted. But the definition is so wide that we probably need to continue to look at that. And so that going forward, that might be something that we can dig into a little bit more, Ralph, is what's our current definition of blight, and where could we make some changes there. Also, I've had other individuals contact me too about looking at periodically resetting the TIF increment. And Justin had brought that up a little bit about inflation and, does that have an impact on the growth? And it does, but maybe periodically looking at maybe what other states might do. If you have met your goals, and should then the TIF increment be rebased every 15 years or 20 years or whatever. So I think that might be something that we could look at too. And then another question is, what can TIF funds be used for? So a couple sessions ago, we did expand TIFs increment could be used to fund workforce housing. The other big question that really isn't in statute is what type of investments can TIFs make? It comes down usually to horizontal versus vertical investment. So if you think of horizontal, that's providing funding for buildings, which typically benefits probably a private business, where more along the vertical would be talking about putting in things like roads, water lines, sewer lines, other improvements that would help increase economic development in that area. So I think that's another thing that we could probably look into a little bit more too. So does anybody else have any thoughts or concerns or comments about any of that?
Senator Hertz,
Sure.
just one thought just came to mind. I think, don't we have a provision in law that once the bonding requirements have been met, the TIF district can start resharing the excess money back to the taxing jurisdictions? And I can't remember if that's a mandatory thing or how that threshold is established, but I
believe
do
that's
know
just
that they end up with
yeah.
MOUs.
I think that's just voluntary, isn't it, Megan?
Yes, there's provisions for voluntary remittance. The only requirement is that if you remit, you have to remit to all entities equally related to their proportion of the mill levy. You can't pick and choose.
So we saw some of that happening in Missoula. Recently, the Missoula city had about a $3 million hole in their city budget. So they asked the TIF to resubmit money back to them and others. That was a $9 million cost to get $3 million back to the city, because of all the other taxing jurisdictions within that TIF increment also got their share of that remittance, which a lot of it probably I would imagine had to do with schools, because just due to the size of, I mean, obviously, schools make up about 50% of your property taxes, but the counties and the schools and everybody else got their share of that too. But that might be something that we could explore too, is like, as you pointed out, Ralph, is as bonds are settled and going forward, then maybe we need to look at sunsetting the TIF or redistributing part of the increment. Although you need to be a little bit careful to make sure that the TIF does not, that it has enough money to make their debt service, because you might have, you might get into an area of devaluation or something where a TIF increment could go down. One thing we saw at the Polson TIF increment, it actually, I believe it went underwater at one point in time, the increment, because somebody had come in, non-taxable entity had bought a building, and it completely took that off the tax rolls. That entire building was inside the TIF, and so that created some problems with the increment, and the increment shrunk significantly. So. Any other thoughts? All right, so it looks like on these TIFs, we will, you can take some notes, Ralph, we'll continue to, maybe at the next meeting, look at blight definitions a little bit more, and if there's anything we can do there. Also, limitations. That's another thing I forgot to bring up too, is, in the past legislative sessions, people have talked about this limitations on the size of a TIF. How much of the total taxable value of a taxing jurisdiction can be absorbed by a TIF? Because that can have impacts also, I think, on other taxpayers. So we probably need to look at that a little bit too. And then also maybe explore the horizontal versus vertical and the type of investments that TIFs can make. So with that, I think we're probably done with this particular topic. So let's move along then. So the next topic of discussion will be property tax growth limitations in Montana. And that has to do with, we're looking at, of course, 1510-420, where local governments are limited to half the rate of inflation, plus, you know, they get the new taxable value from new growth. So we've got some information on that and some breakdowns of what that new growth kind of looks like across the state. So with that, it looks like Eric Dale with the Department of Revenue is going to provide us some information.
All right, hopefully everyone can see my screen here.
Yep.
As for the record, my name is Eric Dale with the Montana Department of Revenue Tax Policy and Research Unit. I was asked to provide some information on newly taxable data, so I guess here we go. All right, so the first thing I wanted to start out with is talk about why newly taxable is relevant, I guess. And the only thing newly taxable really is used for directly is in the provisions of 1510-420, which is the statute that establishes the maximum mill limitations for local governments. So broadly speaking, this is the formula that is used to calculate those maximum mills for the local governments. So just to give you a brief overview, essentially the prior year's taxes are calculated and then adjusted by half the rate of inflation, which is this factor right here. And then that amount is divided by the current year taxable value to determine the mills. However, that current year taxable value is excluding this newly taxable term right here, and then the whole thing is multiplied by 1,000. And it's important to note that these maximum mills are calculated excluding the newly taxable, but they are applied to the entire taxable value of the district. So if there's a big influx of newly taxable value, then these mills would generate more revenue, essentially. The other thing I wanted to talk about briefly is well, I guess this will come up on the next slide, but the newly taxable values are calculated by class, and within any individual class, the total effect can not be less than 0. So there's no negative newly taxable values that are impacting this calculation here. So.
And Eric, the newly taxable property is the new property in the last calendar year. Is that correct?
Chairman Hertz, yeah, it's usually calculated on a annual basis, or it is calculated on an annual basis because mills are recalculated on an annual basis. So to answer your question, yes, I think it is the new property from the prior year is included in the newly taxable, but as I'll get to here in a second, newly taxable is more than just exclusively new property in a lot of cases. So as I mentioned, currently the newly taxable values are calculated on a tax class basis. Statute specifically says appreciation due to reappraisal is excluded from newly taxable, but that only applies to class 4 commercial and residential property. So the class 4 residential and commercial property is more closely tied, I would argue, to what is new property. That contrasts with a lot of the centrally assessed tax classes. Because of the nature of unitary appraisal, essentially the department values the entity as a whole as one unit and then apportions some of that value to Montana and then further apportions that value to specific taxing jurisdictions. So because that is the nature of the valuation for those types of properties, it's often difficult to differentiate between the increase due to appreciation of that property and the increase due to what would typically be considered new construction or new physical property. The other thing I wanted to mention about newly taxable values is when a TIF district expires, the incremental value is treated as newly taxable for those taxing jurisdictions for that first year. And as I mentioned before, because newly taxable is calculated on a tax class basis, negative newly taxable values can sometimes offset each other within a single tax class, but not necessarily across tax classes. So the example to think of here is if there is an increase of $1 million in Class 8 newly taxable business equipment and a corresponding decrease in newly taxable for Class 9, the decrease would be canceled out and there would still be $1 million of newly taxable related to that Class 8 property. If, on the other hand, there was $1 million of newly taxable property for business equipment from Company A and a corresponding decrease of $1 million in business equipment tax from Company B, those could offset and we would see a net zero of Class 8 property in the newly taxable amount. Yeah, I think that's all I wanted to say here. So I was requested to generate some data related to newly taxable, and here's my attempt to display that data. So what I did is I calculated the newly taxable values for each county and then the state as a whole by tax class from 2016 to 2023. So there's residential, commercial, pollution control equipment, so on and so forth. And then there's also the expired TIF increments here. The total line here is the sum of these amounts, including the negative values. And then the total newly taxable would be the amount that is used for the 15, 10, 420 calculations. And that would exclude these negative amounts in any particular year. I also included the total taxable value for the jurisdiction. So in this case, it's the statewide total taxable value. So you can see what percentage that newly taxable value represents. Couple interesting things to note here that I noted as I was compiling this data is if you look at the residential and commercial amounts, they're generally a large portion of the statewide newly taxable value, but there's also several components of other types of property. So for example, in 2023, there was a substantial amount of Class 8 business equipment tax that contributed to the statewide newly taxable value. The other interesting thing is there can be a lot of swings in the total newly taxable for some of these centrally assessed properties. So this line right here is the Class 9 values. So as you can see in 2022, there was a significant amount of newly taxable property related to Class 9 to the tune of $66 million on a statewide basis. However, in 2023, those values decreased, and so that resulted in a negative newly taxable value for Class 9 that was $27.12 million. I think that's all I really wanted to say with this slide, unless there's any questions.
So Eric, obviously this is not adjusted for inflation, is it?
Senator Hertz, no, there are no inflation adjustments in here. The inflation adjustment in 1510-420 would occur in a different part of the formula, but
Okay.
There's no inflation adjustments here.
Yeah, I mean, I think it's pretty, you know, you look at the huge increases in new property and residential and commercial. Obviously, construction costs have, you know, almost doubled in a lot of in residential areas, just the cost of construction. So we may not have added as much square footage as it might imply versus just the cost of doing that. I also is new construction. So on residential, if I put up a new garage next to my existing house, is that considered new construction?
Senator Hertz, yes, we would attempt to account for that in the newly taxable amounts. Sometimes it can be difficult to capture all of that type of information, but the department does its best to account for that.
Right. And that'd be the same as a significant remodel. If I bought an old house, and I'm converting to rental, I pretty much went in and gutted the house. You guys would try to do your best to classify that as new construction.
Senator Hertz, it's my understanding that, yeah, there would be at least some portion of that we would try to account for in part of the newly taxable
All right.
values. So.
Anybody else have any questions or anything before we continue to move on here? Don't see any, Eric, so go ahead.
As I said, this is the statewide values, but this can vary substantially depending on which county you're looking at, or which taxing jurisdiction for that matter. So just as some examples here, here's Gallatin County. Not surprisingly, a much larger portion of their overall newly taxable values are associated with residential property, just the growth that's coming from there. If you compare 29 million, almost 30 million in 2023 to the total newly taxable value of 34 million, similarly in other years, although it's not exclusively. There's also generally a lot of commercial property associated in this area. This contrasts with some of the smaller communities that might be more intensely or essentially assessed, might be a larger share of their overall tax base. So here's Webo County. As you can see, there's not a lot of residential newly taxable property, but there is a lot of other types of newly taxable property in this area. And because Webo County has generally a smaller tax base than some of the other counties, that can account for a substantial portion of their overall tax base. So you can see in 2020, the newly taxable amounts accounted for 21% of their total taxable value. And then again in 2021, it accounted for 30%, 31%, which I thought was kind of interesting. The last thing I wanted to talk about is just, again, some of that impacts for centrally assessed and how that can impact things when those negative values are canceled out. I thought this was kind of an interesting example in Rosebud County. So as you can see here, the total taxable value actually decreased and has been decreasing over quite a few years. But between 2022 and 2023, it went down in total taxable values. So it went from $65 million to $57 million. However, because those newly taxable values aren't allowed to be negative on a per class basis, there was still some increase, or there was still some newly taxable values for the 1510 420 calculations that allowed those mills to grow, that mill revenue to grow. This is primarily related to the coal strip facilities, I believe. But it is interesting to see how that can affect things. I did calculate these values for every county in the state, and those values will be posted on the website. So if you want to go look at any individual county, that will be available to you. Are there any questions about that, I guess, before I go on too much further?
Anybody have any questions? Don't see any hands, so go ahead.
All right. So the next logical question I had when I was sort of compiling or have compiled this newly taxable analysis is to sort of think about how important each of these components are to the maximum mill calculations and the total dollar amounts that are allowed to be levied by the taxing jurisdictions. And so that's what I tried to do with that data. So again, here is the 1510 420 calculation in a somewhat simplified form. And as I said, I thought it'd be interesting to try and examine or analyze how sensitive each of these components are to the overall amounts that local taxing jurisdictions are allowed to levy. So two of the big things that I thought about in this, or that come up quite often in conversations about 1510 420, are the newly taxable amounts that we just went over, and then also inflation. As I mentioned, the inflation adjustment for these taxing jurisdictions is limited to half the rate of inflation, but as has been pointed out often, the costs for these taxing jurisdictions are the costs experience true inflation, 100% of inflation. So I wanted to see what the trade-offs were in newly taxable and sort of kind of examine some of those questions I had. So in order to do this, there are several pieces of data I tried to gather, a lot of which the department has, but some of which we don't. I'll talk briefly about why those are important. So the department has all the certified values, and that includes total taxable values, TIF incremental values, which are also excluded from these calculations of 15, 10, 420, proceed values. As I described earlier, we have the newly taxable data. We also have historic inflationary data and the total mills. So we have a large chunk of the information that's needed to perform this type of analysis. However, one of the key pieces that we are missing is the starting piece, what the amount of taxes was levied in the prior year. As I said, we do have the total mills, so we can get a pretty good estimation of the total amount that was levied. However, we don't have a great way to distinguish what portion of those total taxing jurisdiction mills were subject to 15, 10, 420. And there could be reasons for that discrepancy. The biggest one is obviously voted mills are not subject to 15, 10, 420. And so we don't have a great way of distinguishing what the voted mills are from the permissive mills. The other thing that is problematic in making these calculations is there are essentially provisions that allow taxing jurisdictions to bank some of that unused milling authority so that they're not necessarily in a use it or lose it situation and levying the maximum mills every single year. We don't have great information on that at the moment, and so it's hard to say what the maximum allowable amounts from the prior year would be. But there are some assumptions we can make to try and get at some of this information. So here are the assumptions I started with to perform this analysis. I started at tax year 2015. And the reason I started at tax year 2015 is this is the first year that the phase-in and the homestead and comstead provisions in the property tax code were eliminated, which just made the whole process quite a bit easier. There's also a bit better data availability starting in tax year 2015. So once I had that information, I adjusted the total mills by some information I put together from the local government services data to try and account for that portion of the mills that were subject to 15, 10, 420 and the portion that weren't. So for example, the department has information that might indicate the taxing jurisdiction levies 100 mills, but then when I looked up some of the 15, 10, 420 calculations on the local government services website, they might only have 80 mills. And so I just adjusted those as best I could by counties for the tax year 2015 amounts. And then, as I mentioned, I don't have information on what the authority is with banked mills, so I just assumed the 2015 amounts were the maximum to sort of see how sensitive these calculations were to the different provisions of maximum or the newly taxable values and the inflationary amounts. And then once I had that, I could perform the same calculations for 2016 through 2023 and calculate what the maximum mills were. This doesn't mean that that's necessarily what those counties actually levied, just what their authority was essentially. And then, as I said, we had a bunch of newly taxable information, and this is the same slide as I showed before, just to kind of illustrate what newly taxable is. And like I said, what I wanted to ultimately do was try and determine how sensitive some of the different components of newly taxable are to the overall 15, 10, 420 calculations. So in order to perform this analysis, as I mentioned, calculated the current maximum mills for each county for each year for 2015 through 2023. And then what I did is I recalculated those maximum mills using some alternative frameworks that I thought might be interesting to examine to, again, try and isolate how sensitive the calculations are to these different components. And then once I'd done this, I compared the two results. to see where the biggest differences were. So just briefly talk about some of the different kind of assumptions and frameworks that came to my mind as I was doing this. As I said, there's been a lot of talk about, is half the rate of inflation appropriate? And so I wanted to see how much of an impact that would have for the different taxing jurisdictions if we increase that to 100% of inflation as opposed to 50%. Another piece of conversation that has come up is currently the newly taxable value is essentially a mechanism for local taxing jurisdictions to grow their budgets, but there have been some conversations about whether or not that's appropriate and if those newly taxable values should be used to help lower the mills for the taxing jurisdictions. And if that is the case, how much and what should that scenario look like? And so those are some additional questions I wanted to answer. Another thing that's come up is, should all tax classes in newly taxable be treated the same? There's been a lot of discussion about the costs associated with providing services to different types of property. And I've heard comments to the effect that the costs for providing services to residential property may not be covered entirely by their tax payments. One of the other things I wanted to look at was, should expired TIF increment values be counted as newly taxable, and what kind of impact that would have. One of the other things that ultimately came up was, should population growth be included in this formula? The idea that government should grow at population plus inflation has been talked about quite extensively, and I wanted to sort of see what impact that could have. Should this take the place of newly taxable values, or should it be in addition? You know, those kind of questions. And then one of the final things that was asked was, should there be an overall cap? I mean, ultimately 1510-420 is a portion of statute that tries to limit the growth in mills, and is that effective, and would a overall cap be more appropriate? So those are the kind of questions I sort of thought about as I was doing this. So here's some of the output that I put together based on the model numbers. So this big table over here, I imagine, is probably pretty hard to read, but this information will be provided on the website. But basically, this just looks at what the difference in maximum mill authority would be for each county for each of these years. One of the important things to note is that the prior year's revenue is an important part of the next year's 1510-420 calculation. And so these effects tend to compound over years. So I wanted to look at a broad enough number of years to see what the true impact would be, as opposed to looking at 1 year. So for this particular example, I simply changed the inflation factor and tried to calculate what that maximum milling authority would be if we used 100% of inflation as opposed to 50% of inflation. It makes sense that all of these county numbers are pretty similar because inflation impacts the formula and therefore impacts each county in a similar way. I also graphed the total dollars levied by the county governments over here. So this blue line represents what was actually milled. The orange line here represents what I estimated that milling authority would be under current law. And again, the gap there is because I did try and account for the 1510-420 mills versus all other mills as best I could, but is ultimately an estimate. And then the gray line is what the new authority would be given the various assumptions. So again, because we're increasing the inflation from 50% to 100%, the counties would theoretically be able to levy more dollars, and that's reflected here. And then this map down here is I tried to put these in terms of taxes, essentially. So this is what the taxes for a median home would be, or the change essentially, in 2023. So you can kind of see how that would impact different areas. And the reason, you know, they're all the same percentages over here, but there are different amounts, is generally because the median home values vary across the state by counties. So that's one scenario I looked at, another one that I thought was interesting is if we eliminated all the newly taxable values, increased inflation to 100%, but then added a population factor to see which kind of counties would be better off and which ones would be worse off. It's kind of interesting if you look at, I feel like Gallatin County under this scenario is about the same. They're no better or worse off. The scenario of adding population instead of newly taxable would leave them in a similar position according to these estimates. But in areas where there might have been substantial newly taxable values without a corresponding population increase, they might be much worse off. And you generally see that in some of the smaller communities with larger shares of centrally assessed property. Fergus County is kind of interesting to look at because they had a big increase in newly taxable property associated with pipeline properties. So there wasn't necessarily the population growth that they might have seen. So I thought that was kind of an interesting one. The other scenario I looked at briefly was Senate Bill 511. So in this past session, there was some legislation to sort of make some changes to 1510-420. One of the changes that piece of legislation tried to implement was allowing 50% of newly taxable values to be used to increase budget authority or revenue authority, and 50% would then be used to float mills down. In addition, Senate Bill 511 increased the inflation percentage from 50% to 100%, but it did add an inflation cap of 4%, and then it also added an overall cap, regardless of newly taxable and other factors, of 4.75. So I thought it'd be interesting to look at what would happen under that scenario again. So just a couple things I wanted to make clear about this analysis is, as I mentioned, it is looking at the past. So this, and then saying what the world would have looked like under these alternate scenarios. So it is by no means a forecast. If Senate Bill 511 had been implemented, this is not necessarily what would have come to fruition, because newly taxable can be so variable by county and by year, and so we don't have great forecasts on that. Again, this analysis also looks at what would have happened under the alternate scenarios and our estimates for what actually did happen, and compares the two. So you might see negative values here. That doesn't necessarily correspond to a cut. That corresponds to an increase in the amount, or a decrease in the amount they were allowed to increase, if that makes sense. And then another thing I wanted to mention is this is only looking at county governments currently, and county governments are only a portion of the overall tax bill. So I think it's important to keep that in mind when looking at this. We have started to look at a similar analysis for municipalities. However, there's a lot more variation in some of those municipalities, and so this type of analysis is maybe less straightforward, but we are looking into that. And then the other thing that I think is important to note is this is looking at fundamentally what the limits on county governments are to their total authority. Basically, we don't have this doesn't incorporate decisions by local county governments that might decisions they made to levy less than they were the maximum allowable amount. So just because this is a decrease doesn't, or an increase doesn't mean that's what actually happened, I guess. And so I just wanted to make that point clear as well. But as I said, we have this sort of model framework that we can tweak in various ways. And so if the committee members have any particular model frameworks they would like to look at, we can surely investigate those. These are just 3 that I happen to pull together for example purposes. But with that, is kind of the end of the presentation that I had. So at this point, I'd open it up to any questions if there are any.
Eric, I just had, just to clarify too, under 1510-420 and the Senate Bill 511 and the various adjustments in decisions you may have made, that still doesn't impact voter approved levies. So they're not subject to 1510-420 or even Senate Bill 511. Is that correct?
Senator Hertz, to my understanding, that is correct. Yeah, they are generally, those voted mills are separate.
Okay. Does anybody have any questions or comments here for Eric before we move along? Now's your chance. So there's a lot of good information here, but as you can see, it's very complex, just like everything else dealing with property taxes.
Mr. Chairman,
Yes.
there's some dials on the option that in the scenario tool. And I'm just wondering if that's something that the committee might want to discuss. If there are other scenarios or factors they want to play with these models. This was just sort of to give us some exposure to what's out there, and maybe that's something we could add to it.
Sure.
We have a meeting on April 18th.
Yeah.
If they send us some ideas, we can work some scenarios.
Yeah.
As I volunteer Eric, hard work yet again. And Commissioner Logan just raised his hand as well.
Okay. Go ahead, Sean. You'll have to unmute yourself.
Yeah, thank you. I just, we hear a lot of talk about 1510-420 and the impacts that it has on local government. And one of the perspectives that I look at it as is just a taxpayer. Somebody's got to write a check for local government taxes, essentially. And recently I looked over pretty much the past decade, and I left out this last year's property taxes because of the sort of anomalous nature of it. It was pretty significant increase, but just looked at the property taxes from 2013 to 2022. And this is just taxes. This is leaving out assessments, special districts, all that kind of, but just local taxes. Like, for example, the school districts overall, 70% increase over that decade. Lewis and Clark County's taxes went up almost 73%, and Helena's taxes up 71%. I mean, that's just the dollar amount difference that my wife and I are paying on our particular property. And I would assume that's pretty consistent with people throughout Helena and throughout our county. And then you also look at the inflation over that time, at least according to the Federal Reserve's calculator, and it was 26%. So I guess the point that I'm trying to comment on here is that I'm not sure how effective it is, 1510-420, and that's just looking at it from a guy who writes the check kind of perspective. So anyway, just wanted to make that comment. Thank you.
Yeah, Sean, I would agree with you. And I think that's some of the frustration that the legislature has had in the past. And that's where kind of Senate Bill 511 came from, was to put an overall cap, because there are workarounds to 1510-420. Special districts is one of them that we've kind of shored up a little bit, but not as much as we could. Obviously, voter approved levies, different areas like that. But so I think, visiting this, what are alternatives to 1510-420? And one thing too that Eric we didn't discuss here, but new growth is kind of like a compounding interest. So yeah, you just subtract out the new growth for the first year, but then it becomes part of your overall budget base for the following year. So that has increased, and you have a compounding. And so that kind of also is why, budgets grow at more than half the rate of inflation. So there's just a lot of complexities here, and figuring out how to, what's a fair way to cap without hamstringing local governments and schools at the same time. So, any other comments?
Mr. Chairman,
Sure.
excuse me. I think we need to reiterate the fact that this tool was trying to look at the unvoted permissive levy growth. And so since the department made the tool, I don't want them to get beat up for
Right.
the wrong things here. There's a lot of voted mills in this. I agree with Commissioner Logan, inflation, I just loaded in the number for 2015 to now, and his number is correct. It's something around 30%. It has been just sort of base CPI inflation. But he was also talking about the total tax bill with the exception of the fees. So how much, we don't know how much that growth is due to voted levies. I do know that the administration, working with the Local Government Services Center, is trying to get at the issue of, can we separate out the information from voted mills and non-voted mills so that we can do a fairer comparison of these things, and we can understand what is driving tax bill growth. That's just sort of trying to touch the bases on what we're working on.
Yeah. Go ahead, Sean.
Thanks. And I just like to add that, and I think that's kind of a theme that we're hearing is that we can't distinguish between the voted and non, but in any case, like for the city of Helena in that time period that I mentioned, which was 2013 to 2022, I'm pretty certain we only had one voted levy in that time period, and so it wasn't like there were a lot of voter approved levy increases. So just a point here locally.
Mr.
So when you
Chairman,
were talking about your tax bill, though, were you talking about the city taxes or overall?
Yeah, well, it's
county?
all kind of in the mix,
Right.
I pay city, county, schools, and so on, but within just the city of Helena, there was, with the county, there were several initiatives, bonds and levies relative to jail and that sort of thing. But like just the city taxes, I might be wrong on this, but I think we just had one levy. So it's not entirely like clear to me that it's, any increases above inflation are the result of, voters taxing themselves. So
Yeah. Okay.
anyway.
Good comment. So looks like Pam Holmquist's got her hand up. Go ahead, Pam. You have to unmute yourself.
Yeah, I think can you hear me?
Yep, we got you.
Okay. All right, so I asked Mr. Osmondson to kind of zero in on my tax bill and give me a decomposition of my tax bill and what that actually looked like and where it was all going. And I guess I just would like to recommend to the committee, have your tax bill looked at and have it do the same thing for each individual, so you can understand maybe better where all the increases or decreases or where all of the money is coming from and how you're being taxed. I just got it this morning, so I kind of previewed it a little bit, but it's really interesting, and I think it's a good tool that Eric Dale came up with, that kind of shows what your personal property taxes are doing, which may be helpful for the rest of the committee to look at. So just a suggestion to the rest of the committee to have that done.
No, that's a very good suggestion. Also, if you happen to live in a county that is using Tyler tax software, you can go in, and if you go onto their website, generally under Pay My Taxes, Review My Taxes, you can get a very good detail from their software. It'll even show you pie charts. A lot of them show comparison of this year to last year. So you can actually see where your taxes increased. So it's very good. Generally, the larger counties are using that software. The smaller counties, not so much. So on small counties, it's more difficult. You pretty much got to lay your tax bills or have someone help you side by side and see what it looks like. Pam, did you have some more comments? Your hand's still up, or?
No, that's it. I'll put my hand down.
All
Thanks.
right, good. Okay. Does anybody else have any comments here?
Yeah,
Justin, go ahead.
as a comment, I suppose, any limit rule like this is inherently going to be a top-down central planning type of act, right? And so it's affecting the incentives of how the locals are going to behave, right? And so it seems like that's like if this is a limit that's applied to what local governments can do without voter approval, then what it's doing is telling them to go, to voted mills more heavily, right? That's the incentive of trying to make that more stringent. So you have elected representatives to handle questions like, what should the budget be? How much should we try and raise? And then the rule then is trying to play into it, define like, when should they have to go back to the voters to directly ask again, right? And then when you have the factors like new growth versus unit growth from regular appreciation as an adjustment to what that levy can be, it's encouraging the locals to prioritize some types of property appreciation or development over others, right? Like, I don't know if that is the intention of it or not, like, but it is nevertheless the consequence of defining these things. So if you want those things to become more stringent or less stringent as new property is developed or new whatever, then that distorts the incentives of the locals. They should respond to that incentive by changing how they make decisions, whether it's investing in a park or a school in order to that will cause property appreciation versus trying to approve the development of a new neighborhood. Like, if that's the intention of the rule, then it's worth thinking about how those incentives feed into it, right? If we would rather it be more neutral with respect to the types of decisions, to not to sort those things, then we'd want to think about those things as well. A comment, not a question.
Good points. Yeah, I mean, as always, the decisions that we try to make or limitations put on have dramatic impacts on different areas, different counties, different governments, different behavior of everybody. So, Dylan, did you have a comment, question?
Yeah, thanks, Senator Hertz. I was just going to add the additional context of the 1510-420 doesn't apply to all mills, and voted mills aren't just that part. I think the other big part, at least that I've come across, is permissive medical levies. So municipalities provide health insurance to their employees, and that is not based on taxable value of the jurisdiction. That's based on the need of the employees. And so, like, with reappraisal being so large, I tried to estimate what mill levies would be for my own property, and I was completely off. And a huge part of that was the permissive medical levy of the city of Helena. And that's not subject to 1510-420, and we don't have a way to decompose the mills that are levied that are subject to 1510-420 and the ones that aren't. So Eric's tool, those caveats that he mentioned at the start are actually really important, and we did our best to try to account for that, but that will always hamstring our simulation effects and our ability to talk intelligently about why taxes are increasing, is that we cannot suss out the differences in these mills.
No, that's a good point, particularly something in regards to like health insurance, which we all know the rate of inflation in regard to healthcare has more than doubled in one of the higher rates of inflation compared to everything else, so. Any other comments? So one thing about this tool that we can use going forward, as Ralph kind of pointed out, what they're working on too is in order, so we'll be able to kind of pick and choose. So do we want to allow, you know, if we were to use something like this, local governments go to full rate of inflation, population growth, what would you do with newly taxable? Bring it all in, bring 50% of it in, quarter, different classes of property. Would we bring those in? So it's just, there's a multitude of things that we could use to maybe help us make some decisions going forward and maybe further investigating the Senate Bill 511 model, which we'll probably review at a future meeting to get a little more details as to how that might help slow the growth of property taxes. But at the same time, as Justin pointed out, is that just going to change behavior to whether it's voters or behavior on part of the local governments too, to try to do a workaround. So let's see, no other comments? Okay, looks like I'd like to move into some public comment about this newly taxable or 1510-420 scenarios. So if there's any public comment out there on attendees, please raise your hand.
Mr. Chairman,
Yes.
I did double check with some people who are outside the panelist pool to make sure that the raising the hand feature actually works. So people do have an opportunity, and just wanted to get that on the record that we're trying to allow for effective participation. But
Great.
there's also the website. There is the public comment link out there as well for people to comment on this process.
Okay.
So it'd be important to get it on the record.
Sure. So I don't see any hands raised out there. So I guess the next question here is, as we've gone through this tool and looked at it, what are the next steps for the committees? Maybe with the simulation tool and potential changes to 1510-420. Any thoughts out there? Any further investigation that we would like to do? I think one thing that I'd like to see us, and we probably put on the agenda for the next meeting, is dig into Senate Bill 511 a little more. So we can kind of see, get some information on that. And Eric's tool would be very helpful on digging into that a little bit more. Senator McGilvery.
Thanks. I just want to go back to what 1510-420 applies to. So it doesn't apply to voted mills. It doesn't apply to permissive medical levies. So I guess it begs the question to me, what does 1510-420 actually apply to? I think in the city of Billings, it doesn't apply to, because we're a charter form of government, so we're a little bit odd. But what would it apply to specifically then?
So I guess I'll clarify. When we say 1510-420 doesn't apply to voted mills, what we mean by that is that when people take that concrete jump of voting in a certain amount of extra dollars into the budget, we can't, if we only think about things in terms of 1510-420, we can't explain that discrete jump. But oftentimes when mills are voted in, they then become subject to 1510-420 and they grow from that point. So we're talking about not being able to account for that discrete jump. The big things that 1510-420 does apply to is like the county general fund. That's the big thing, that and the city general fund. General funds are subject to 1510-420. And so when we focus in on just those funds, then 1510-420 is good at predicting what is happening. But, you know, when we try to explain the whole property tax picture, that's when we're a little less sure.
So it'd be fair to say that once those voted mills have been voted in, after the in the next cycle, then 1510-420 would apply to them. Is that?
If they're voted in as dollar amounts, then yes. Sometimes they can even be voted in as mill levy amounts, and in that case, 1510-420 would not apply to them. And it would be like the example of Billings, where the entity is authorized a mill amount, and whatever dollars that mill raises is what they get.
Sean?
Thank you, Mr. Chair. So just to give you an example, this was from our 2022 resolutions. We pass annually a resolution that sets the annual tax levy in mills. And it's broken down for us in group health insurance, number of mills associated with that, general obligation debt, and a certain number of mills associated with that, limited general levy, and then we had a fire department supplemental levy. Each of those different areas had a different number of mills levied. The only one that seems to be limited by 1510-420, as was just pointed out, I think, is that limited general levy. And then I think it's accurate to say that any, like our fire department supplemental levy, once it was passed, then it does, yes, become subject to that. But yeah, so it's somewhat limited.
Ralph?
An astute listener to this meeting pointed out that the vote for a mill levy can explicitly include 1510-420 in the levy language. So just an important point. It can be added, in which case it does become a binding constraint on the voted levy.
Oh, yeah.
Yeah, you can make it subject to 1510-420 if you would like. I learned that in the past in bringing legislation also. If you're going to provide certain items, should they or shouldn't be subject to 1510-420. Any other comments? So moving forward, I think, I'll work with Ralph and as we move forward to explore this a little bit more. I mean, today, and as a lot of our meetings are, we're getting educated on what information is out there, what different impacts that this information we have. We get tools like Eric's developed, and how does that help us make decisions? I think we need to continue to explore and maybe dig into Senate Bill 511 a little bit more as to actually how it impacted or could potentially impact different taxing jurisdictions. How would that overall cap? What would that be capping? All the different mills, things that are excluded, not excluded, different areas. And then, of course, we've always got we've talked about voter approved levies that really are up to the voters. We've talked about, and the Education Subcommittee yesterday talked about voter turnout, voter dates, and they're still exploring that on that particular side, because as we know, a lot of property taxes are self-imposed on property taxpayers. They just want those things for their communities, and so. But a lot of times too, as we've discussed in the past, it's a majority of the minority who are imposing those taxes on everybody, but your failure to show up and vote, that's what you get. So going forward, probably our next meeting, maybe we can explore this a little bit more. There's also been some other conversations I've had with other individuals about even maybe putting more voter control into overall general fund increases. I think across the country, there's been some more transparency bills passed in some states that actually more or less don't allow growth in local government budgets unless the local voters come in and approve that. And so that's led me down another path too, that it's interesting. You look at the budgets at the state legislature, our state budget, we start working on our budget in January or even months before that, before we jump into the new fiscal year starting July 1, we have our budget set. Our local governments and our schools are actually 4 months generally into their budget year before they actually finalize their budget for that particular year. So it does become difficult if you start putting some restrictions on them. And part of that process is they just don't know what's our revenue. When are the certified values from, property tax, and when does that come out? That comes out in August generally. So then they can set, what their mills are, et cetera. So I'm working with Tony Heineman at Legislative Service Division and doing a little bit of research. From what I could gather out there, about half the states are on a calendar year when it comes to their local governments. So then it kind of allows them to maybe look at their budgeting a little closer, get more input from voters, et cetera. But those are, it's complex as you change things and put more pressures on local governments, then they need to have the tools available to them to make those decisions. And right now, they're into four months into their budget before they actually maybe know what their total revenue picture might be, and they can finalize those mills to some point. So need to probably discuss that maybe with the Department of Revenue a little bit more too, about as to what can be done to accelerate the process, if anything, for certified values of property, especially now that we're on a 2-year cycle and databases are much more easily accessible with computers than it was, 15, 20 years ago. So those are just some things that we'll continue to work on. Pam, did you have, see you got your hand up?
Sure. Wanted to talk a little bit about county budgeting because yes, we do start in January, but we have a pretty good track record to follow. And with the cap, with the 15-10-420 cap, it actually helps us to budget because we know what inflation is or what it's going to be. We can project pretty well what's going to be there. And we start into the budget year with those, projections. And then that gives time for each department to kind of come up with what their needs and wants and all of that are, and their capital improvement budget and all of that. And it takes a while to get all that done because we have several departments that are looking at that. But at the end of the day, normally we come fairly close by the time we get our valuations in August. And so we've taken a really good look at a lot of stuff. We've looked at our insurances, we've looked at, health benefits, all of the other stuff that we need to look at. And so we've had a lot of discussion, a lot of thought, a lot of consideration for the public and the community. And we really kind of know what our community is too. I mean, every community is a little different. So I think overall the counties and the cities, even though they may start early, they have a pretty darn good handle on what's coming up. Do they have to adjust in August? Yeah, it's always a little bit of an adjustment, but normally we fall fairly close. So I just wanted to add that the 15-10-420 is a good tool for us in that it gives us some consistency, I guess, in what we do. And then the voted portion of that, it would be, I mean, we take a lot of public comment during our budget process. And then to go back to say, well, the voters should be voting on your general fund. I really think that would be a disaster, frankly. I mean, they have time to come in and comment. They have time to visit with each and every one of us and give us their thoughts. But with 15-10-420, we're capped anyway. So, that's what we can tell them. Well, we're capped, right? Which we are. And that just helps us budget better. So I think most of the time the counties budget fairly well. If a county gets a lot of property tax, their taxes go up or whatever, it could be any number of things. But it's normally what the people are asking for. So just wanted to add that comment. Yeah, that was it, I guess.
All right. Yeah, thanks, Pam. That really helps. When do you guys, so generally is your budget pretty solid by May or June or?
Oh,
when-
yeah. Yeah,
Okay.
we started in January with a retreat. The commissioners set baselines. There's months of the staff meeting and conversing and getting all things together. And then we look at each staff comes and presents their budget to the commissioners in May. So we spend the whole month of May with each department, looking at all of their budgets, line items, whatever it might be. And then in June, we compile all that and we look at any sidebars, like if a department wants something extra for the year, that's put in as a sidebar. And we do what we think we can do with the projections, and some sidebars are approved at that time. Some sidebars are say, well, we'd like to do this, but we got to see what happens in August. So we have a pretty good idea of what we're going to do. And if we have extra money in August, then we may go back and approve that sidebar, whatever that might be. So we pass a preliminary budget the end of June, because we have to be able to write checks on July 1. So we pass our preliminary budget the end of June, and then we actually pass our final budget in August with some budget amendments, because by then we've got some amendments that we have to do depending on the taxable value that comes in.
Yeah. What would you think of like an overall cap, like Senate Bill 511 had, just saying, okay, yeah, you can grow your budget, but we're going to cap it at 4.75 or pick a number.
I think what number should you pick?
Right. Yeah.
I mean, right now we're basing our cap on half of the rate of inflation, an actual thing that's going on, right? Inflation is easy to calculate, and know what that is. So it helps us to know kind of, because we have a pretty good idea in the spring what that inflation rate's going to be, and we know we're only going to be able to get half of the rate of inflation. But it's based on something that's, I guess, legitimate. I don't know, otherwise you're just kind of guessing. What should that rate be? Should it be 4%? Should it be 8%? I don't know, right? It's arbitrarily picking a number that may or may not work. So that's kind of, I guess, the issue that I have is, what is that rate, right? And I could actually, I used to know what it is, but I could get a hold of our finance department and figure out just what that percentage has been over the years, a half a rate of inflation, right? Has it been 3%? Has it been 4% historically? I could find out what our budget does, but like I say, every county is a little different. But I could get you that number, whatever that is, how much our budget has gone up each year. Maybe the Department of Revenue already knows that.
Legislative Fiscal Division's got a lot of good detailed numbers on that. And of course, you're right. I mean, when we get into these periods of very high inflation like we have for the last couple of years, it really skews things. Those of us who lived through the 80s particularly know that. And then everybody else was in, for a couple of decades, inflation was pretty much non-existent due to maybe some policy decisions at federal government, which has led to some of the other problems we have. But that's a different discussion.
Yeah, that's a whole different discussion.
Yeah. Sean, go ahead.
Just a quick, for what it's worth, what Ms. Holmquist described as their budget process from beginning to adoption, very consistent with what happens here in the municipality of Helena. It really starts with the staff's development of the budget in late December, January and then adoption in the summer typically, but that was remarkably identical. So thanks.
Yeah, I think, and from a legislative standpoint, it's somewhat similar. I mean, the executive branch is working on their budgeting leading up to a few months before the session, and then it gets fairly compressed during the legislative session in January through mid-February as the presentations and really digging down into those numbers. So I think we're all pretty similar on that. So Senator McGilvery.
Yeah, just two things. I went to the website of the county and downloaded a property tax report on my old house, which we just moved recently. So it wouldn't do any good to have it on this house where I live now because it was just built last year. But it's interesting. It goes all the way back to 2004, and for $1, I got their whole report. I also list all the sex offenders by my house too, for my old house. Just that was extra.
Yeah.
But I have a question for Pam. I'm just curious, what would you think about the idea that the state in 1510-420 allows for no inflation, and that it's all pushed back to the local level, where the city council or the county commissioners determine what inflation they will apply to their budgets, and then that goes to a voters for a certain amount of years or something like that. That's just a real high level, but can you give me your thoughts?
Sure, Mr. McGilvery. I think the average individual out there, including myself before I became a commissioner, does not understand the county budget. And when you don't understand something and then you have to vote on it, it's hard to do that, right? They all say their property taxes are too high. They think that check that they write to the county all goes to the county, and it doesn't. So I like the cap because the cap makes us accountable. If we have to pick a number off of inflation and then go out to the public, I don't know that we could educate them enough to make a good decision on what they're doing. So,
All right, appreciate the input.
yep.
It's interesting. I just went on and logged onto a county website where a month or two ago I could get a comparative analysis of my taxes from 22 to 23. That option is no longer available on their website. I don't know if it's something to do with software update or what's going on, but it's interesting. Okay. Anybody else have any comments, thoughts, discussions as we proceed here? So it looks like 1510-420 is definitely something we need to continue to discuss and work on and see what's possible solutions. Is there something better out there than what we have? So it needs a lot more vetting, as Commissioner Holmquist pointed out too. So that will be something that we'll look at probably at our next meeting. If not, if we can't fit it in then, after that. But I think dealing down to Eric's tool a little bit more and looking at Senate Bill 511 a little bit more might give us some more input. And the counties did help in working on and drafting Senate Bill 511, so they had a lot of input onto that particular bill too, as to the process. So all right, so I guess put that behind us. Pam, you just got your hand up, but I assume you're done. Yep. All right. Okay. So finally here, we're getting close to wrapping up here. Just have a few follow-up items from our last meeting. I guess first item on the agenda is county non-levy revenues. Ralph, what do we got on that, if anything?
Okay. We do. Let me share my screen, although I got to make sure I find the right one. I think it's this one. There is a handout out there. Can you see this? It says Property Tax Advisory Council. This was done pretty quickly. I've not seen it done in a long time, and I don't know if it included everything. So there's all sorts of caveats on this, but I think we can get a pretty important lesson. So I have two things that were follow-up. One is a quick look at how important non-levy revenue is to counties, and then a quick run through the two initiatives and the one bill that has tried to be run through the system for limiting property taxes by a constitutional initiative effectively. So let's start with my estimate of county non-levy revenue. It's sort of complicated because there's a lot of different sources of data. We don't have the fund balance data. We don't really have the revenue data from the counties the same way. So I had to use a lot of the Department of Revenue's tax collection data from the shared tax.
So all I can see right now is your desktop. Were you trying to share something?
I was trying. Oh, did I? Oh,
All right.
okay. Sorry.
There we
I
go.
wanted to be able to look at the camera and see the thing. Thank you very much for. So I had to make an estimate of non-levy receipts at the county level. So I looked at the shared levies that are mostly from natural resources revenue. It's about 96 million bucks, and I also had to do it for fiscal year 2022 because that's where I had all the data. And we have about $96 million in natural resource revenue that we share with the counties based on the statutory formula. I included the entitlement share payments, since those go directly into the base. They're supposed to go into the general fund, and the entitlement share, for those who aren't familiar with it, it's really a process back in 2001 where we had all these small revenues going back and forth between the state and localities that we tried to rationalize and figure out one net thing so that we simplified the accounting back and forth. And then it's also been used as a way to compensate for elimination of property tax base at the state level. The state will put money into the entitlement share program that allocates resources back to localities based on a formula. And then what we do is we plug in the reimbursements to the tax cut that way. So that creates an interesting problem for the state, since we are about 18% of the property tax levies, but we have to compensate for any tax-based cut we do to localities. It's become the habit. So it costs us about 5 times as much as our revenue loss to reimburse localities so mills don't float up. So really quick version of entitlement share. Right now in fiscal 22, it was about 148 million bucks. All this was data from the biennial report. I also pulled since I do the property tax estimate, one of the things we track is the federal receipts. I don't actually, PILT payments, I don't think are shared with the state through the our school mill shares, but federal forest receipts definitely are, and they can be important. So PILT, about 38 million. It's a direct payment from BLM to the counties. The commissioners would probably know that process way better than I do. And then the Forest Service payment for rural schools. They used to call the 25% payment in fiscal 22. It was 14 million bucks. And then to estimate the denominator, I just took all the county property tax mill for countywide school levies, county government, county local school district levies, which statewide was about 1.3 billion. I didn't count city and town levies, special districts, or fees. So I think these numbers also exclude various other intergovernmental transfers. In the case that I really do know, federal forest receipts, since those are shared revenues with the state based on the our equalization mill share, that some of that comes back to us about 18% of it comes back to us. But we also have other state oil and gas receipts that go into the guarantee fund, that go to schools. So it's sort of an estimate. So if I do it, I'll show you the tables, but here's the high level. About, if you count entitlement share statewide, about 18% of county government and consolidated, county school receipts were non-levy revenues. If you exclude the entitlement share payment, so it's a significant thing, it's much smaller, about 6.7%. And the non-levy revenue is basically really concentrated in the 5 oil, gas, and coal counties. So there's an issue of what the incidence of these payments are. So here's the roll up, and this stuff is, all these presentations today are on the site. So basically I took the state share dollars, the federal payments, to come up with an approximation of non-levy revenue. Then I tried to figure out what the tax base was based on county mills that these revenues get shared with, and you come up with these approximate shares. I highlighted a few that are low, mostly because, interesting, it's not just big population counties. Gallatin County was only 7.9. Golden Valley, which is a small county, was pretty low. And Lake, surprisingly, also low. But then if you look at some of these coal, oil, and gas counties, the coal, oil, and gas money is a big deal. So they basically, as you can see here, if you go back up, this is the countywide school mills. They have no countywide school mills. I kept these lines through the rest of these tables, but and here's the detail on where the shared revenue came from, keeping the lines so that you can sort of follow. Oil is the big deal in the places you would expect. And then this is federal forest receipts and PILT funds. I can't remember, and maybe Commissioner Holmquist can remind me, if the PILT monies go straight to the county general fund, or if they're also split between the county road fund and schools, like federal forest receipts are. So this table out there.
Yeah, our PILT money is put into a separate fund, and we use that only for infrastructure improvements in the county.
Okay.
And that's why we don't see a lot of bonds, because any remodel, any new additional space, anything is paid through PILT. SRS goes partially to the road and partially to the schools. 2/3
to the county road fund, if I remember, of the Title I portion.
Yeah, it's 1/3, I think, to the county road and 2/3 to the school. I think the school gets more.
Oh, they.
Yeah.
Well, don't they always?
Yeah.
So that's what this is. That's how I came up with this table up here. A lot of caveats, but I think it tells the story, and it's an issue of, we talk about the counties out east have a lot of class 9 tax base that, covers a lot of their costs. Some counties have non-levy revenues. Other counties just have population and a lot of infrastructure for that and building. So, but we have to keep in mind that the diversity of the sources of funding as we look at these property tax issues. Are there any questions on this portion?
Ralph, is there non-levy revenue out there that you can't account for that might be going to local governments?
I don't think it's a really significant thing. I know there used to be tailored grazing fees. State PILT payments got rolled into entitlement share. Depending on what county you are, that was a good deal, and for some counties, there's some feeling that the state is not paying its full share there. We've seen several bills in recent years on that, but I don't think, I can't think of anything, and maybe the elected officials who have to operate local governments know something I don't.
Okay.
And, well, they know a lot of things I don't, but on this particular issue. So I don't know, that was just to give a scale. And I'll move on to the next thing. I really did the initiatives very quickly. And what I really did is we have the fiscal notes for the last 3 attempts to do an initiative. They're in there. I think I think we should start with just the very first one that came through because it was a little bit more narrow. The idea was to limit, to change the basis of assessment for residential property to the property tax values that residential property had in 2019, and then only allow up to 2% growth for inflation in the assessed value unless you significantly remodeled or you sold your house. So it's sort of an acquisition value system, but it's a modified acquisition value thing. That part of the bill was workable, other than the fact that it creates that problem of separation between sort of legacy owners and new owners, with creating a lag, or depressing the taxable value of legacy homes with respect to the market value of homes in real life and anyone who bought a new one. So that creates a lock-in effect. There's all sorts of things that happen there. And I think maybe for the next time I will just use median value home and do a simple example of how that gap developed. Maybe we should do that. That really wasn't the issue with the bill. Everyone, it's like the Prop 13 kind of thing. But the main issue that happened was with the 1% cap, that property taxes for a resident could not exceed 1% of its assessed value. And this is now the new reduced assessed value based on the new, the 2019, starting from the 2019 starting point. Because we have the tax rates for Class 4 residential property at 1.34, it effectively set a mill cap of around 740 mills for all property in a jurisdiction. A total cap of 740 mills for residential taxpayers in a district. But then you have this issue of the stacking jurisdiction, mills set independently. So how do you control if you get over that 1% limit? How do you shift, or can you shift the levies? And I'm very happy to see that Dylan turned on his camera, because he's the guy who did all the hard work here, and I hope he will correct all my material mistakes. So that was one issue, just how do you ensure equity and when you have this mill cap? The other two newer initiatives, to try to avoid, I think the reason they came up with it is to avoid the shifting to other classes of property. They decided to expand the initiative to cover all real property. And because our forecast didn't really include growth in some of the other classes above 2%, the only class of property that was affected by the assessment limitation was Class 9. And let me back up a minute. So the first initiative basically took away about 25% of the statewide property tax revenue. So it wasn't as big, and it probably could have been dealt with if you could deal with the shifting between jurisdictions. The newer initiatives, by expanding to all real property, now means you expanded to other classes of property with different tax rates, which sets a different maximum mill levy level. And to the extent that you have to tax all taxpayers in the jurisdiction at the same millage rate, it creates a real problem. The bill effectively, we think, reduced property taxes to about 12% of the revenue base is all that would have been left with the other initiative, because we figured out that it cut about 88%. And then when you look at how it affected other classes, other jurisdictions in total statewide, you can see they were really significant. Dylan, do you want to fill in anything, since I went through this fast and perhaps even incorrectly?
No, I think that was a pretty good summary, Ralph. I guess, yeah, I would just stress that the limitation on the assessment growth is not nearly as problematic as the limitation on the percentage of value in terms of modifying our existing structure. Like Ralph said, your property tax that you pay is really a combination of 5 or 6 or 7 different payments to different entities, and they all budget separately. And so when you provide an overall limit on what can be assessed against a property, when different entities are making budgetary decisions without communicating with each other, it's very easy for the total millage to exceed that limit. And so any kind of proposition that would limit the percent of a property's value, the total amount of taxes that could be raised against a property as a percentage of its value, any kind of proposal that would have that would require a massive overhaul of the current property tax system to execute that sort of law change.
Well, I think dealing with the shift was very difficult. Obviously, if you live in a city, you're most likely going to hit that 1% cap much faster than someone in the county. So then it was like, how do we, once you hit that 1% cap, then what are you going to shift? How much are the school taxes? Are they going to get shifted to those county residents who are in that school district? City residents pay county taxes, so then are more of those county taxes going to be paid by county? So it just really gets difficult, and kind of it was a major shift initially to county taxpayers, but then as everybody else hits the 1%, then you basically just start starving all taxing jurisdictions with limitations on their revenue. And I believe in California, of course, California had a sales tax, and they've seen their sales tax growth, and they pretty much backfilled local government and schools with sales tax. Is that correct? Is any? I believe that's kind of where it all headed to.
Yep. A shout out to the Legislative Services Division. I'll find the list of where this issue was talked about at Great Lake. Mostly it was whether about the legality of moving the initiative, but there's a lot of work that was done on this. Jarrett Cole has a write-up of this, and Megan's documentation of these kinds of things for the Revenue Interim Committee over the last, well, over a long time, but in particular the last 2 or 3 sessions. It's been really in-depth and I think very helpful. I think the committee should be aware of that also. But for this kind of, for the initiative stuff, I will send out a list of which meetings and where those things can be found. It's sometimes hard to find things out there if you don't know they're there.
Well, another issue too is, I mean, if you're capped at 1%, you got more voter approved levies coming at you. Why wouldn't you just vote for them? I don't think you're not going to impact me. It's going to impact any other taxpayer in that jurisdiction. So that become another problem too. That was very difficult to, work around on that too. So I think it's probably worthwhile to. This was just a high level overview, and maybe in future meetings to dig into this a little bit more. Obviously, it's a lot of discussion out there in the public has talked about this particular, and I continue to see it talked about. But I think there's just a lot more consequences out there than a lot of people realize and think about going forward. Particularly, I know in the real estate industry too, was they weren't happy with it, mainly because you got, you know, $500,000 house here and one just few blocks down the road, and their taxes are completely different. I mean, it could be sizable different amount depending on how long that individual, when they might have purchased the property. So it does create long-term issues too. So
I wonder if any of our, I think some people had to leave but Dr. Roth, I don't know if they're still on. I mean, in California, how did they get around does our constitutional requirement for equalization, because it's in the Constitution, although would have been amended by this bill, do we have other kinds of limitations? And how did California get around those kinds of equalization issues? Must be interesting to see. If anyone has any information about that, that would be helpful.
yeah, I don't know. Justin, are you still out there? You got any comments on that or knowledge? And I know Manish, he had to leave.
He did have, yeah.
The Tax Foundation, I'm trying to join their meeting. They have one at noon that's going to talk about national property taxes across the nation and issues that are going on. So, Pam, you have to unmute yourself.
Yeah,
Pam.
before we leave the meeting, I just wanted to stress one more thing to the committee. I know we as we talk about property taxes and the cities and the counties, property taxes are really our main source of funding. That's really all we have. And so if we were to having to go out to the voter to approve our budgets every year, and let's just give a scenario that they say no, what do we do? Do we lay off people? Do we shut the doors? I mean, we have no other source of income to backfill that or stay in business. So I just want everybody to kind of think about that. Thank you.
Yeah, no, I would agree with you. I think although the voters might just be sending the message that, yeah, I think when the local government, if that was the case, local government will be able to say, okay, fine, if you're going to not allow this, these are the services that you will lose. So then the voters, and which is always difficult to get that information out to the voters, but it's something that, you know, they have to realize that they're going to reduce revenue or cap it. There may be some services, or most likely to be services that will be reduced. Oh,
Do we need to just figure out where we go from here? And I think we sort of covered it a little bit, but just where do you want us to go?
Yeah, so our next meeting is scheduled for April 18th from 9 to noon. And on the agenda for that meeting will be the local option sales tax group that's been working with a couple of different counties. I've asked them to come and do a presentation for us. I've asked them to basically present 3 things. You know, what items would you want to tax and at what rate? And, you know, what would be your plan to use those taxes for, whether it's property tax reduction or whatever, and how much revenue could you generate? So they're kind of tasked with coming to us with that information so we can kind of flush that out a little bit and see you know, what they are thinking about. Also in the next meeting too, we'll work with Ralph, but probably maybe get a little more discussion on the Senate Bill 511, and then flush out some of the issues too that we had discussed about TIFs increment going forward. So Senator McGilvery?
Yeah, Senator Hertz, which counties did you ask to have looked at for the local option?
So I'm working with Jen Hensley. Jen's a lobbyist, and I know she's been working with Missoula County, and I believe Gallatin County might be involved in that. So I'm not sure of their entire compass of their group, but they've been working with other local government entities.
I guess I would just say this with regard to Yellowstone County. And I'm just gonna speak off the cuff here because I haven't thought it through, but I think we have a unique situation in that we're so close to, northern Wyoming is really close, and we get an incredible amount of cross-state revenue from out of Sheridan or other parts of northern Wyoming. And that's for sure that other counties, particularly counties with larger metropolitan areas, have that same kind of situation. Just thinking off the cuff here.
No, it does have an impact. You're right, Senator. Those people from Wyoming driving up to Montana to buy things because they're not subject to sales tax. In my neck of the woods, up in the northern area, you've got Canadians coming across because they have their go south tax up there, which is pretty excessive, and so they come down into Montana all across the High Line to buy clothing, other personal property, and take it back up to Canada. So there's a lot of consequences when we start looking at various tax policy and how mobile people are. So Ralph, anything else that we might want to look at on 418 there? Or?
So one thing Megan has made me aware of, apparently Alaska has a municipal sales tax administrative unit, because that's one of the problems when you don't have a statewide sales tax, how you do the sharing of outside vendors being able to comply with your sales tax laws when it's not run by the state and you don't have a central clearinghouse. So apparently municipalities have some kind of central clearinghouse. And that thing, so I can reach out to them and see if someone could explain how they do it up there, because that would be more similar to what we would have to do. I think that was the main thing. And I just wonder if we have our, what do we really want to focus on? And I guess I want to point out that we've got to produce some kind of report by the 15th of August. So focusing on the issues and what we want to propose at the end of this is sort of important.
Yeah, I mean, the way I kind of see this going forward, of course, as we discussed, we're not drafting any bills here, particularly language for the legislature, the governor to deal with, but it's more a thought process. So, I mean, there might be things like tax increment financing. The committee recommends that we look at these 3 or 4 different areas that need modifications to maybe make that more friendly to other taxpayers, or whether it's 15, 10, 420 recommendations on that as we move forward, or local option sales tax, different areas, voted levies, thresholds of voter turnout, which the education subcommittee has more or less taken over that. But I mean, that's kind of how I see this process rolling together as we move forward. And we still have a lot. I mean, right now we're kind of in the educational process of gathering information. There's a lot of good information out there today that we need to spend a little bit more time. And I'd encourage you to go to the website, kind of review some of the stuff that's been posted up there. So that's kind of how I kind of see us moving forward here. I don't know if anybody else has any comments.
They must all agree.
or they're really tired too. So sorry that's these meetings get drug out a little bit longer, but there's just so much information out there. So I am going to give one more option to public comment before we jump out of here. So we got a list of attendees out there. If there's any attendees who would like to make one final public comment, please raise your hand. And as Ralph pointed out, you can always go to the website too and provide public comment through that or contact anybody on the committee too and send us emails, which I've gotten a number of those, so. All right, well, I don't see any hands raised out there, so a reminder, our next meeting will be Friday, I believe it's Thursday, April 18th, 9 a.m. to noon. We'll get an agenda out for that. And then also just a reminder, the entire committee is meeting on April 22nd. Isn't that correct, Ralph? Do we have a time on that?
I think we do, but I don't recall what it is.
Okay.
1 p.m.,
It's
Mr. Chairman.
All right, 1 p.m. So that's where we're going with that. So without anything else, I will adjourn this subcommittee meeting. So thank you for everybody participating today. See you later.
Thank you.